We're half an hour away from the opening bell. Hong Kong, Shenzhen, and Shanghai. You're watching The China Show. I'm David Ingles with Yvonne.
Our top stories this morning. Top Chinese officials offering assurances on the economy and markets. The PBOC governor hinting at a triple R cut. And the CSRC chair pledging action during extreme market failures.
Stocks across the region getting a boost as Fed Chair Jay Powell sticks to script, backing rate cuts at some point this year.
And a Bloomberg scoop, the U.S. said to be facing resistance as it urges allies to further tighten curbs on China's access to chip technology. All right, a quick look at the market action here today. So yes, we're relatively speaking risk on. You take a look at how equities are doing in the region. We're up about 0.6%. No surprises from that Jay Powell testimony. So the market is liking that sort of news. But S&P futures are in the red here this morning. The Bloomberg Dollar Index is flat. We're watching yen. We're basically below 150 for the first time in a month or so, I believe. So 149 trade for your dollar yen here this morning. You're certainly seeing a lot of price action when it comes to the banks, CGBs, the like, CGBs, JGBs, I should say, but CGBs also are part of that discussion, right? Yeah. As you talked about, it was the Avengers of China policymakers. And just talking about, you know, there's still more room for triple R cuts. That was from Pen Gongsheng, the PBOC governor. You have talks of maybe more consumption sort of plays here in South, and more on that program as well. And CGB yields plummeting. We're getting very close to record territory now and how low those yields can go. Yeah, we're certainly at record lows as far as the CGB curve is concerned in terms of flatness. In terms of absolute yields, we're about 8 to 9 basis points from taking out the record low we hit back in 2002 at 2.264. As you can see in your 10-year yield, it's been a softer dollar of late, which probably is helping risk assets today. I think we're down for a fifth day, quite a sharp drop in the U.S. dollar overnight. We talked about Jay Powell, perhaps less need for a pushback right now that markets have coalesced around Fed expectations. In terms of what to expect today, so it's a decent earnings day. Bilibili, MTR, Prada, Wharf Real Estate comes out with earnings today. The big one, though, will be in the form of this press briefing, the top of the next hour, from Wang Yi, of course, the highest ranking official, Chinese official, to be set to speak, of course, this week, at least as far as press briefings go. That's top of the next hour. Dollar China, as you can see, we're back below 7.2. There we go. All right, let's get to what we heard from, of course, that top economic panel of officials here talking about the government's targets and policy moves that could come next.
This year we have set the target at around 5%. This is a decision made by the CPC Central Committee and the State Council based on balanced consideration of various factors. The target is in alignment with the goals and the requirements of the 14th Five-Year Plan and commensurate with the potential of economic growth.
At present, the statutory reserve ratio is 7% on average, and there is still room for future cuts.
The recent volatility in the market once again exposed some deep-seated problems which deserve serious reflection. We need to strengthen investor protection in terms of laws, institutions, regulatory enforcement, and judicial practices so as to give them greater trust and confidence in the market.
Let's bring in Stephen Engle, our Chief North Asia Correspondent. He's in Beijing for us. Steve, you were at that actual press briefing, and we were just playing some highlights for our viewers. 2.5 hours. What stood out to you there?
Yep. Yeah, did Yvonne call this the Avengers of Chinese policymakers? That's interesting, right? So you had the lineup of the 5 different, government agency heads and obviously regulators, including Wu Qing, the new CSRC head, at a time, of course, when they're cracking down on fraud. There was so much covered, but really none of them went off script. They were essentially reading their answers by multiple bullet points. And again, there is frustration in this economy, in this nation, really, about policy clarity, really, because there was was, at the end of the 2.5-hour press conference, there was a rush by the journalists to the stage to try and doorstop and get clearer answers, because they were clearly reading from a playbook, and almost every single answer from every single one of these 5 gentlemen included acknowledgement of the leadership of the Central Party Committee and, of course, the leadership of Xi Jinping. So it was clearly a party-driven press conference by these agency heads. So you can see, and we all know that Xi Jinping wants to put more party doctrine and party discipline into these agencies. So that was an overriding theme. There was lots covered, obviously. We just ran through some of those sound bites. They justified the need for this around 5% GDP growth, but it's going to take vigorous efforts, according to the NDRC chairman. Probably the most newsworthy point made was from Pan Gongsheng, the PBOC governor, essentially saying there's still monetary tools, room for easing. And he mentioned the RRR cuts, the 2 previous ones adding about 1 trillion yuan in liquidity to the market each time. There are more tools and room for perhaps more RRR cuts. That was the most newsworthy. But probably the most interesting was from the CSRC chairman, who really talked, and he was very colorful. If any one of these 5 went off script, it was him more. He added a little bit of humor, if you will. He called himself a rookie, and the crowd laughed, chuckled really, because this guy's no rookie. He might be a rookie in this position, but he is known as an enforcer. He is known as the broker butcher back in the early 2000s. He went in and closed down 31 different brokerages in Shanghai and around China, essentially for malfeasance. He has been appointed the CSRC head from the very top to instill discipline and return confidence in the stock market.
And there were some interesting comments, too, about urbanization, Steve, and the need to welcome migrant workers into the fold. But what was said there?
Yeah, you know, Yvonne, that hukou reform. Hukou is the household registry, the residency permits, if you will, for people. If you were born in Beijing, essentially, you get a Beijing hukou. There's been lots of political resistance to opening up the hukou system to migrant workers. Of course, the Chinese domestic economy is so reliant on migrant workers going to the different places around China, away from their hometowns, and working. But then they don't get the hukou residency. And some have called this discriminatory because they're essentially cut off from housing, education, and other healthcare services and the like. So the NDRC chairman addressed this in saying, as urbanization has been a paramount theme to drive economic growth and, the domestic economy. We've seen urban residents from 1979, it was just 20% of the population. About a decade ago, it was 53. Now it is 66%. So the pace of urbanization is slowing. They need migrant workers. They need those migrant workers to come up into the middle class. So he was talking about essentially, opening up hukous to the 179 million migrant workers. And that is a significant step. And clearly, it is also a priority of the party under Xi Jinping's common prosperity theme. A lot of these comments that were read out yesterday were really dovetailed nicely with the common prosperity theme, including from the finance minister Lan, who talked extensively about, yes, there's every penny will be spent fiscally where it is needed, but there's going to be belt tightening. And he did an entire answer on fiscal belt tightening, 20% reduction on overseas travel, no extravagant parties, no vanity projects at the provincial level, belt tightening at this time of slowing economy, and fiscal constraint and debt burdens was emphasized. But curiously, and this is my last point, none of the 5 gentlemen specifically mentioned the turmoil in the property market specifically.
Steve, thank you. Our chief North Asia correspondent, Stephen Engle there. Just a wrap up of that press conference here, and it really was, the Avengers, right? If you think about if the Fed, if the Treasury, Department, if the Commerce Department all joined into one sort of joint conference, that was what we saw. Let's bring in Ecaterina Bigos, CIO for Asia ex-Japan at AXA Investment Managers, joining us here in town. Great to have you. Is there anything that you learned this week from China that can really move the needle for you on whether this recent rebound in equities can last? Was it reflationary enough, you think?
Yeah, well, I think the biggest surprise, I think, for everybody is certainly the market has hoped for a much bigger stimulus, a much bigger support. It has delivered as not as hoped, but as expected. We expected there would be a measured and gradual package. A gradualism is certainly in focus. And I think one point to say is the supply focus is the biggest surprise. So if you look at the package, it's largely focused on supply. What it means is going to be still focused on investment. Things like urbanization, infrastructure are still going to drive the growth for China, expected to lift the growth for China. The biggest disappointment is certainly a lot more needs to be done for consumption. Consumption is subdued, and there are signs of obviously excess capacity in the economy, and certainly reviving that consumption will support taking some of that excess capacity from the economy. But we know that the confidence, the consumer confidence, is closely related to the property market and to the job market. So we're seeing slack in the job market, and certainly the property market hasn't shown signs of recovery. So it's not a straightforward exercise, and one element to consider is that there is no precedent or rule book in which China should follow. There's no precedent to where they can shift the gear from the current economic environment to the next level, where they're aiming to deleverage the economy. They're aiming to focus more on consumption versus on investment. So certainly that takes a measured and focused effort, but also it requires a gradual effort where the market or the officials can observe the effects of various measures that have been put in place. So again, not surprises, but not as hoped by the market. So market is certainly expected a lot more, particularly done for consumption.
Yeah, and one of the key issues the market has, taken issue with is just the lack of inflation, because that has an effect on things like earnings, for example, spending and capex. And I'm wondering what assumptions you might have your assumptions change on the inflation environment in China for this year, from a market perspective, of course?
Well, certainly the China is in disinflation at the moment. So we had the latest CPI, which is still negative. I think the part to say for 2024, inflation is expected to pick up, and I would say largely driven by food. And we've seen a certain pressure, particularly from pork prices, where it has put a lot of downward pressure on particularly the food contribution to the inflation. We do think that expected to adjust. Some contribution potentially from the property market. Tier 1 and Tier 2 cities, arguably, they have scope to recover and see some velocity in 2024. So some marginal contribution potentially from property market. But the bigger question in terms of getting out into a high inflation or slightly high inflation, again, the 3% is not the level they're aiming for. It's a cap to where they're aiming for. And again, getting a high inflation certainly needs addressing the excess manufacturing capacity that exists in the economy, and there are signs that capacity is there. By looking at PMI numbers, you can see that excess capacity. So addressing that disinflation still requires addressing that excess capacity. And as I said, one way to do it is certainly addressing the consumer confidence. And we've seen some targeted efforts around consumers, but they're not yet significant to move the dial to kind of take that excess capacity out of the economy.
So what does it mean in terms of your exposure and what you're leaning towards now? Is it likely to increase your exposure to China more, and what part of the market?
So I think if you look at the elements of China, we kind of look at four pillars generally when we look at different asset classes. So we look at macro, the valuations, we look at the fundamentals, and we look at the sentiment. So if you look at the macro environment, as I said, it's still a challenge. It requires a lot more targeted effort for the economy to rebound and to see the inflation recovery, and certainly the lack or slack in the economy related to inflation, related to the labor market, to see some recovery. So the macro is still challenging. If you look at the fundamentals, or if you look at the valuations per se, arguably many market participants saying that the valuations are attractive. But if you consider the current challenges that China is facing, it is certainly attractive, but there are risks there that need to be considered. So I think the scope is certainly for technical recovery, potentially, as the officials are putting a lot more efforts in driving consumption, in driving the economic growth. The longer-term story certainly is a bit more dependent on how successful they're going to be on implementing those measures. And the last point, and I think this is one that potentially maybe is not as talked about, the sentiment is very subdued. The sentiment is a big element for China market, and the ownership is still very much onshore. 70% is owned by the onshore China is owned by retail investors, which requires a sentiment boost and a wealth creation, and that's that's not existent. And when it comes to sentiment, that's weak onshore and offshore, of course, we need to see a lot more courage from the foreign investors to come back in China. I think it's going to be a harder challenge to bring the foreign investors back to China.
Out of those 4 pillars, just real quickly, what's most important to you to make sure that this rebound holds?
Certainly the macroeconomic is a big, I mean, how policymakers are aiming to implement the measures and said revive the economy, take the slack out of the economy that ultimately is going to contribute to the growth of earnings. It's a very important element of it. Yeah.
Okay, and perhaps that could be the biggest change because the other 3 pillars have largely been a feature of this market. Ecaterina, Bigos, of course, will be staying with us. Lots more to talk about there. Coming up, JD.com out with earnings, approving this buyback to $3 billion. Fourth quarter earnings beat. Shares are looking substantially higher. It's looking like the stock is going to go through the ceiling. We're called, I would say, about 10% higher, give or take. A recap of the numbers coming up. Counting down to the open of trades. In Shanghai, in Shenzhen, and here in Hong Kong, futures are pointing slightly flat, slightly down. This is the China Show. Good morning. Welcome back. You're watching the China Show. The U.S. is said to be pressing its allies here to further tighten restrictions on China's access to semiconductor technology. Let's bring in Debbie Wu, who leads, of course, our North Asia tech coverage. Debbie, what do we know about this latest foray into sort of just tapping China's access to key technology?
Right. So there are 2 parts to this. So one is that U.S. is asking the Netherlands and Japan, which are already in a loose alliance with the U.S. to block China's access to advanced chip-making equipment. So essentially, the U.S. wants the 2 countries to tighten China's access to their chip technologies. So that includes a specialty chemical that Japan is a leader in. So it's a chemical called photoresist that's required in the chip-making process. And then this is the first time that the U.S. is looking to limit China's access to a chip-making chemical. So previously, we saw that the U.S. Has been restricting China's ability to acquire AI chips and chip-making equipment. But this is the first time that chip chemical is becoming a focus in the protracted U.S.-China tensions. And at the same time, the U.S. also wants Germany and South Korea to be part of this alliance to limit China's access to cutting-edge tech. And how South Korea and Germany will react to that, we all have to wait and see.
What has been the response so far? Because it seems like that not all countries are quite on board in terms of scrutinizing further these chip exports and the like. What are they saying so far?
So Japan and the Netherlands, according to what we understand, have responded coolly to U.S. proposal. They want to see the impact from the current chip curbs on China first. And then on Germany's side, it's Vice Chancellor Robert Habeck is actually in the U.S. this week, and then he's expected to meet with U.S. Secretary of Commerce Gina Raimondo later this week. So it should be really interesting to see what comes out of their talks later this week. And we don't know much about South Korea's reactions yet.
All right, Debbie, thank you. Debbie Wu there, our North Asia tech team leader on the latest when it comes to chips. We're focusing on JD.com. Those shares just opening up in the pre-market in Hong Kong. And we saw that 16% pop in the ADRs on the back of those better than expected numbers when it comes to sales and revenue. Also a bit of a surprise, I guess, or good news with that $3 billion buyback. So the stock up some 8% in Hong Kong. Also, we'll take the rest of the market, what we're tracking here, so maybe that could be a good lift for HS Tech here this morning. CGBs, that rally continues here, especially when it comes to the long end, just given what we heard from the PBOC and the comments that we saw in that press conference. We're at 226 for your Chinese 10-year yield. We're down some 2 basis points still. We got plenty more to come. This is Bloomberg. All right, already seeing plenty of price action here this morning. We're watching JD.com, so we saw that pop in the shares here after those results. We're watching BYD. There's going to be a big stock repurchase, I believe, when it comes to the A shares, not the H, though. That's what we're tracking right now. And we're watching chips very closely, Tektronic as well. That one on the back of their earnings. It was an interesting note that we got from Citi, too, just talking about how those results played out. Also, Bilibili, Prada, MTR Core, and Wharf are all reporting later on today. So a bit of a flavor here when it comes to the consumption side of things, too, there, Dave.
Yeah, everything from, well, e-commerce, drills, of course, real estate as it pertains to MTR as well. Right, okay, these are some of the earnings coming through, as Yvonne is pointing out. Big moves coming through in your Wuxi-related names here. So Wuxi Bio is down 15%. Wuxi Aptic should also be seeing some pressure right now. The news here, U.S. Senate committee advancing this biosecurity bill that would block certain Chinese companies, including those on your screens, from getting federal contracts. We are getting a little bit more in terms of, okay, we're fighting this again. Anyway, can't have too much of a good thing, can we? Okay, pre-markets, please, if we can. HSI, HSCEI. We're looking at the fix of the day in case you missed that out at 710. Against the U.S. dollar. Some repo operations coming through, draining 107 billion renminbi in open market operations. Same rate, 1.8%, slightly lower in Hang Seng. HS Tech building on the momentum from yesterday. A lot of that might have to do with the fact that JD.com is up 8%. Yeah. We're also looking at the Japanese yen as we speak. So we were trading at just about 149 30 minutes back. We're way below that as we speak. 148.84. A lot of these BOJ policy normalization trades have been picking up. Yields have been picking up. The yen's been stronger. Risk reversals have been pushing lower. Banks have been outperforming. And the latest here is government officials backing a BOJ rate hike. Now, the consensus is still, the jury's still out whether that's going to be in March or in April, if any.
Yes.
As far as that conversation's concerned.
I think, yeah, it's maybe more of a toss-up and better for April in terms of where consensus lies here right now. But it's interesting in the scoop that we have is that several government officials say the central bank should not miss an opportunity to end the world's last negative rate with its first hike since 2007. So they're seeing sufficient evidence now of a virtuous cycle tying wages to price gains. That's why you're seeing that strength come through in the yen here this morning. In terms of analyst actions to tell you about, there's a few that we're tracking when it comes to JD. So on the back of those earnings, those ADRs raised at Barclays there from a price target of 39 from 35. Xing Energy raised to hold at Daiwa, and Tektronic price target there raised by Citi. They're saying they're pretty impressed by these results and doing quite well when it comes to the U.S. and EU as well, that side of the business. All
right, so the Thursday session, a lot on deck, including the press briefing from the Foreign Minister Wang Yi, top of the next hour. We could get some data today in terms of forex reserves in China and Hong Kong as well.
Trade, too, but I guess they already disclosed some of that during that press conference, right? Double-digit rise in exports so far this year.
January to year-to-date numbers coming through. There we go. Although I think they weren't too clear on the denomination, whether that was dollar or renminbi. In any case, we're just being pedantic here. Anyway, the open, 3 minutes away.
All right, quite a lot going on when we're talking about this China show here right now. We're kind of down the opens, and we're already seeing quite a bit of price action here when it comes to JD.com earnings. Healthcare stocks getting pummeled here on the back, what we're seeing in the U.S. with this biotech bill. And we're watching very closely. Wang Yi, the foreign minister, is going to be having his press conference in just about 30 minutes or so. So any clues on where we are when it comes to geopolitics, the light, but certainly there's been a lot of talk about how we can keep this rebound going. And, you know, right now I think the jury's still out about what's really going to take for this rally to keep going, Dave.
Yeah, there still seems to be a gap between, you know, the number of around 5%, how they get there, and certainly the inflation conversation is still part and parcel to that. They talked about ways to promote big-ticket item purchases like consumption, of course, and anyway, more on that in a moment. When you look at, though, the open, as you can see here, some momentum coming through across these markets. We were up overnight, and certainly tailwinds coming out of Wall Street, and the fact that Jay Powell did not give us any sort of hawkisher price did help things along. We're still looking at the 10-year CGBs, for example. That was quite a big move, 5-6 basis point drop yesterday, right after, and in fact during the press briefing where Pan Gongsheng actually came out and said there is room to lower rates even further. Down 5, we're only about 8 basis points away. Change the boards, please, if we can, from that record low we hit back in 2002, around 2.18%. Sector movers, as you can see on your screen, CSI 300, MSCI names here, bottom of your screen. There's a nice earnings team coming through as well. In fact, JD.com's coming up in a couple of seconds here, up 8% in your pre-markets. We were up already, by the way, yesterday. So JD.com, BYD Asia is in focus. There's a buyback there in A shares. We're up 0.6%. We're moving towards 9% now. Chips in focus. We talked about a scoop earlier on that the U.S. is pushing more of its allies here to do more in terms of restricting China's access to semiconductor technology. Defense stocks in focus on the back of also some commentary coming through. This one actually just coming through in the last few minutes or so. Wuxi AppTech, Wuxi Bio, getting substantial losses right now. Certainly this bill in the U.S. that would then restrict some of these Chinese names, among others, to be more specific, and just hedging there, from getting U.S. federal contracts, down double digits there very quickly. I mentioned earnings as well. So Bilibili, Prada, MTR, and Wharf Real Estate among the names coming out with earnings today, and certainly on the back of JD.com earnings. Bilibili is going to be very much in focus there, and that's coming up. There we go. Yvonne.
Yep, and we're taking a look at what really is moving. And it's the CGBs, as you talked about. And it really started from these comments that came out from the PBOC governor, Pan Gongsheng, who sees the possibility of more RRR cuts for Chinese banks. Take a listen.
Last year, we cut the required reserve ratio, or RRR, twice by 25 basic points each. Last month, it was cut by another 50 basic points. That means we released about 1 trillion yuan in long-term liquidity at a time. At present, the statutory reserve ratio is 7% on average, and there is still room for future cuts.
All right, a glance at your CGB market where, when you look, I think the 2s and the 30s are at a sort of record low as far as flatness is concerned. We're still continuing to see pressure coming through. Wow, and the 30-year yield is now 2.4%. We're down about a further 4.3 today. Plans, of course, to issue more treasuries, special purpose bonds, of course. Let's bring in Stephen Chiu, our Bloomberg Intelligence Chief Asia, FX, and Rate Strategist, to talk us through this. Do we get to record lows in yields, is my question.
Very likely. Now, if you look at the CGB curve, actually, so it has dropped basically across the curve, especially the 10 years. So now 10 years is very close to the record low of just below 2.2%. We're just a few basis points away. So obviously, the main reason is because market is expecting further triple-out cut, as Governor Pan said yesterday, further policy rate cuts this year. So they're going to try to push 10-year towards record lows. Now, I'll be cautious, actually, beyond that, just because now we always look at the 1-year MLF. Now it's 2.5, but 10 years are already at 2.26. So when we reach record low, if that happens, I'll be cautious. The market may want to take profit. And what if like China's macro data recover? So beyond record low, I'll be more cautious from here.
It's interesting that we're seeing this rally despite that big buzzword, right? Ultra long Treasury bonds.
Yeah.
I mean, tell us a little bit more of the significance of this program, and how does it meet the multiple goals that policymakers are looking for?
Yeah, that's actually less relevant for the near-term move, but for the longer-term strategic goals that China is planning. That's super interesting because, as we know, it's the 4th time that China announced the special bonds. Usually, it's about like special goals. Like before, we have the replenishing capital of the 4 big banks, setting up CIC, and most recently, of course, the pandemic in 2020. This time, they add the word ultra-long, and actually very interesting. Yesterday at the press conference, so the head of NDRC actually sort of threw out a new buzzword, 两重. There's 2 importance. What are the 2 important strategic goals and to secure the safety of important sectors? So this is all about geopolitics. Now we know U.S. election is coming up. 2025 is a benchmark that people are talking about whatever happens. So you can see that China is planning ahead to try to secure semiconductor, energy, food security, and all that. And what's even more interesting is like Bloomberg News actually broke this in January, but we were just thinking it's a one-off. But actually, out of the Liang Hui, the 2 meetings, they were saying that this is just the first year of many years ahead. So they're going to do it again next year and again the year after. What it means that they're going to go ultra long for many, many years. So you can tell China is trying to secure very low-cost funding for strategic goals going forward.
Yeah, and I think we're going to show that on the screens. What's different from 2024 and 2020. There we go. So the blue bars you see on your screens right now. So my question, short term, what does it mean for the currency that all seems currency negative?
Yeah, now actually you can see that yuan is actually doing nothing just because like PBOC is holding the fix, the dollar is not moving. So to be fair, it's actually more a rate story. The currency is doing, it's not relevant for the currency. Now what's going to change is unless the Fed starts to cut even further, like market expect 3 times probably the Fed will have to do more than that for the dollar to collapse, and PBOC will have to stop cutting rates, which we know is not going to happen. So it's going to hard to change the yuan outlook.
I have a question on that too, because certainly with expectations, Pan Gongsheng yesterday said there is room to cut. Some of the commentary coming out, Goldman Sachs think that maybe China may have to wait for the Fed to cut before they move on rates. What's your
Actually,
call on
we have
that?
to be specific because Pan's just talk about triple R cut. So now that the rate is 7%, he said there's room to cut further. Now, cutting triple R will help the front end, will help interbank liquidity, and the purpose of that is probably because they want to issue special bonds, ultra-long special CGBs, LGBs as usual. So that will help the bond issuance to go smoothly without spiking the rates. But for the currency, for policy rates, he didn't say anything, just because that's more relevant for FX stability. And to your point, yes, I do agree that they want to look at what the Fed will do in March or like probably even May and June before they start cutting policy rates more aggressively.
All right, Stephen Chiu, thank you. Our Bloomberg Intelligence Chief, Asia FX and Rate Strategist. Let's bring back Ecaterina Bigos, CIO for Asia ex-Japan at AXA Investment Managers. Yeah, it is about the Fed. Obviously, that Jay Powell testimony didn't offer any surprises, which was a good thing for the market. But do you think investors now have more confidence in the trajectory of where rate cuts are going to be this year?
Yeah, I think it's. I agree. I think the stance that Jerome Powell has taken is positive. We did say in our outlook at the beginning of the year that the pricing into the year end of 2023 was excessive, so market was a bit too optimistic in terms of expectation of rate cuts. And in absence of a recession, which has been our central scenario, there's no reason for the Fed to cut rates aggressively. So the June seems the most likely scenario, and 3 cuts seem plausible. And again, very much data dependent, but with the resilience that we see in the economy, and certainly the indications that Jerome Powell has given that the economy is staying resilient without saying kind of soft landing, but they've indicated that there is resilience in the economy. There is no arguments into favor of cutting aggressively. Normalizing monetary policy is where we're seeing it, and we do think Fed has scope to normalize monetary policy to bring them in line with the existing growth trajectory for the U.S.
Should investors start reducing dollar exposure?
I don't think this is a story for dollar weakness. There has more other dynamics, of course, and it's relative to individual countries and currencies, of course, and monetary policy in individual individual central banks. So I would say softness in dollar expected, but whatever that will see a significant correction in dollar, it's unlikely.
When it comes to treasuries, though, how should we look at this, right? Because is monetary policy more important or fiscal policy? Because everyone's talking about what this U.S. election might mean for fiscal policy. If we're talking about exploding deficits, are we likely to see a reversal in this bond rally that we were talking about earlier this year?
Yeah, and I think the fiscal deficit for the U.S. has been in the limelight, and we've seen a big debate in the government in terms of how to manage that debt ceiling and the fiscal deficit. The point to say here that demand is recovering for yield seekers. So we're seeing demand in treasuries coming from global. We're seeing demand from onshore. Again, the yields have been the highest that we've seen for over a decade. So the yield seekers are coming to buy. Buyers in Japan, as much as market expected Japanese investors to pull a little bit pull down the demand for treasuries, it hasn't happened. So we've seen demand even from Japan continuing. Global investors are buying treasuries. So we don't see that supply or extra supply of treasuries will not be met by demand from investors. So ultimately, macro is more superior in terms of the dynamics, and the fiscal, of course, it's in the background and something that needs to be addressed, but is not an immediate concern.
Are the risks now more balanced as far as just overall valuation of treasuries right now? I mean, the Fed's told us 3, market's now at 3. Where do we get the volatility is what I'm trying to get to.
And you said rightly, I do think it's more balanced, and we said, as I said, into the year end, that the rally that was there was excessive, and now it seems more fair where it is, but we do expect marginal volatility on the various data points. So CPI, obviously the payrolls will be very closely watched, and depending on that number, we'll see a residual volatility. It will be less than in 2023, certainly coming closer to where the Fed needs to be, but certainly around data points, we do expect some volatility in two ways.
Just want to venture out of bonds just a little bit in terms of what you're looking for in terms of opportunities in the equity market, right? Is this a beta market right now when you take a look at the outperformance that we've seen in stocks? Or is it really now the time for thematic investing in particular?
Well, it's certainly one thing I would say, certainly not a beta market at the moment, and across the board, not just for the U.S. We do stay a lot more constructive on themes. We do think that thematics are countercyclical to the macro volatility that we're currently seeing. We've seen supportive measures from the government. If you look in the U.S., of course, we had the CHIP Act, the Inflation Reduction Act, which has been countercyclical to the global growth, or the growth that they've been seeing, and the inflationary pressures. So normally in an environment where the inflation is elevated, you will see less fiscal support, but they've managed to pass significant packages that are supporting the themes like technology advancement and the energy transition. So that's going to stay. Automation is going to stay as labor costs are increasing, and there's a drive for, particularly for places like China, to elevate their manufacturing capabilities, increase productivity, and certainly the ability of countries to drive technological advancement, to bring automation, to improve productivity, I think will bring returns and will bring investors back in. So we say themes are superiors to kind of the macro levels and some of the macro volatility that we're seeing at the moment.
Yeah, I mean, speaking of AI, I mean, TSMC now is up 3-4%.
Record.
There's a time and place to be obsessing over valuations. NVIDIA's trading at 80 times, Supermicro Computer's trading at 90 times earnings. Do I need to start worrying about valuations at this point in that cycle, or can I just ignore that for now and ride the momentum?
The point to worry about valuations is if we see blips or negative news around AI development. So certainly any news around regulatory restraints around AI development could put some pressure on the actual push for various technology companies to bring AI to fruition. So at the moment, it's very much about build. So semiconductors are going to stay in demand. And semiconductors are not just part of AI. They, in consumer electronics, is the biggest part of AI use, and certainly, of semiconductors use. So certainly that's going to stay. Semiconductors demand is going to stay going forward. The questions for individual stocks, of course, is the incumbents are benefiting, but we have newcomers that are taking some of the market shares, and we've seen some of the European newcomers that are taking some of the market shares. So certainly it's not a straightforward trajectory, but I would say the theme of semiconductors is here to stay. Individual companies, again, you have to do a little bit more of assessment of competitive drivers and fundamentals. Yeah.
It was a pleasure to speak with you. Thank you for spending the better part of the last 40 minutes with us here on set. Ecaterina Bigos there, CIO for Asia, ex-Japan at AXA Investment Managers. Right, we're about 13 minutes into the session, and most equity markets are still higher. The Hang Seng Index has since reversed its earlier strength. Plenty more ahead. You're watching The China Show.
All right, HS Tech is doing this right now, and certainly you got to factor in how JD.com is doing, right? And yes, no surprise, it's the top of the list here today with the pop of the shares of about, I think, if I can squint, it's 8%.
8.18. I have better eyesight than you.
Okay.
I'm just near the screen.
Okay, but yes, no, it basically is the outperformer, and it's really lifting most of this benchmark here today. Yeah. Although it looks like we're slightly in the red this morning when it comes to the broader benchmark. Let's talk a little more about those earnings and bring in our technology reporter, Jane Zhang. First off, your take on these. It seems like they have a strategy in place to really start fending off rivals like PDD.
Yes. PDD really had this strategy of low price strategy, and JD usually, is famous for selling like the big ticket items like the 3C products, smartphones, home appliances. But in recent years, especially since last year, they have also kind of like copied PDD's idea of like discount free. So that's also a strategy in line with China's consumption sentiment now, I think.
The buyback program's also the big one.
Yep.
How big's the buyback? Have they done this before? And obviously markets are liking this buyback announcement.
Yeah, this one is a big one in the company's history. It's up to $3 billion. And actually, the company had several similar share repurchase programs before. Like in 2025, they had a share buyback program of up to $1 billion and another $1 billion share buyback program in 2018. And before the announcement, they just finished another one of up to $3 billion. So this is really a big one. And I think, they really kind of like the market reaction is really good.
Jane, thank you. Jane Zhang, our Bloomberg tech reporter there on all things. JD.com shares, as you can see, are surging. Day two, by the way, massive move up yesterday, massive move up again right now. Staying in tech here, Bloomberg has been speaking to people involved in Apple's failed electric car project, trying to find out really what went wrong there with really one of the most, or at least the company's most ambitious and costly investments, cost on your screens. Mark Gurman, of course, with today's Big Take right now, joins us to talk us through this from San Francisco. Mark, what went wrong and how much was this bill?
It's funny, I asked someone who was pretty involved in the project that same question you just asked me. What went wrong? And their response was, what went right? Right? So there you go. $1 billion on average annual spend. Some years were less, some years were more. There were some ramp-up periods, some ramp-down periods. Obviously, the investment in the budget shifted based on that. But if you take an average over the decade, it's about $1 billion a year, as we wrote in today's Big Take. There's some great details in there about how there was indecision at the top of the company. There was disagreement within the Apple Car management team as well, known as the Special Projects Group. There were so many off-the-wall ideas Apple considered. Microphones on the outside of cars to pipe in audio from outside instead of having the ability to roll down the windows. Curved glass sides, level 5 autonomy. The interior was a mix of a living room and a private jet, right? Having club-style seating, having seats that can turn into recliners, other seats that can turn into footrests, giant television for watching Apple TV and using FaceTime, gaming in the car, using a Xbox-like controller or an iPhone app to control the car. If you had an issue with the level 5 autonomy, you can call Apple from the car and they can drive you remotely. So just an incredible amount of engineering and ideas went into this car, ultimately resulting in nothing.
And it seems like behind that indecision was also Cook's focus on cars. But there seemed to be a divide on whether to focus more on that and compete with Detroit, for example, or continue this reliance on iPhones and compete with Samsung. Tell us a bit more about that.
Well, this was a comment from an executive who was part of the decision-making at the time. Where are we going to go next? And they felt it would be much easier to compete with General Motors in Detroit, which obviously was having multitudes of issues back then, versus Samsung. It's not that Apple's not going to continue to compete with Samsung and some of the other consumer electronics companies. But in terms of their next step, maybe it makes sense to deal with a little bit of an easier competitor. So they thought. Obviously, the competitors might be a little bit easier because everyone is dealing with these issues, but the indecision, the frequent strategy shifts, at one point, the car project was shut down, right? Temporarily. They scaled back from full car development to autonomy development. So certainly this had so many twists and turns. And I think some of the coolest anecdotes in the story was this big meeting that Tim Cook, Apple's COO, other executives had in Arizona at the beginning of 2020 before the COVID pandemic in the US, where they tested a full level 5 prototype of the Apple car. And they came away, they loved it. They wanted Apple to go full throttle, launch this thing by what would be next year, and they weren't able to make it happen. A big part of that is indecision. A big part of that is profitability concerns. And a big part of it was the autonomous technology that they're looking for is just probably 2 decades away from now, I would say.
All right, Mark, fantastic piece and really going in depth on what really happened behind closed doors with that car project from Apple. Our technology reporter, Mark Gurman, joining us from San Francisco. Make sure to check out the big take here today. Also delve a little bit more deeper into maybe even acquisition talks with car companies before they eventually, according to our reporting, had to back down on that project as well. Markets are doing this. You are seeing when it comes to onshore, looking a little bit better than Hong Kong here today. We're flat on the Hang Seng, up about 1/3 for your CSI 300. This is Bloomberg.
Okay, the BOJ is giving us something to talk about today. Well, Japan in general. So this is a move you do not normally see out of the Japanese currencies. Half of 1% move in dollar yen down is certainly much more. It's worth noting here. Some government officials are said to be backing a rate hike out of the BOJ. Certainly the talk of whether we're there as far as inflation is concerned. We had real wages coming through, by the way, a couple of hours back, supporting maybe that view that they are headed in that direction, March, April, or maybe sometime slightly after that. The BOJ trade is on this Thursday.
Oh, yeah, it's live. I'm thinking March is live now, too.
That's in a couple of weeks.
Yeah. So certainly that's one to watch. Beyond that, here's what Greater China is doing. We talked about that divergence with the CSI 300 up about 1/3. So HS Tech, despite what we're seeing in JD, the rest of that space is still looking quite negative here this morning. You're still catching a bit when it comes to oil. Iron ore is doing quite well. We're up about 1.5%. But really, the talk of town is CGBs. Look at that. We're still seeing the long end continue with this rally, and we're just a whisker away from hitting record lows on the 10-year. The 30-year yield is also down this morning as well. You take a look at the rest of Asia is doing a lot better, though, in some ways. You take a look at how APAC is up about 0.4%. And it's really all sectors except for consumer discretionary and healthcare that seems to be in positive territory right now this morning. Coming up in the next hour, we'll be looking at Beijing's decision to set an ambitious 2024 growth target with Morgan Stanley's chief China economist Xing. Also, just a few minutes away from the Foreign Minister Wang Yi's press briefing in Beijing. This is Bloomberg. Welcome back to the China Show, hour 2, of course, for this Thursday morning. And we are awaiting, of course, that press briefing happening right now in Beijing with the Foreign Minister Wang Yi set to meet with the media there. He is the most senior official to be having a press conference this week at the MPC. So there will be a lot of eyes watching what he says. Obviously, Dave, there's been a lot of talk on Taiwan, what we've been hearing from the president telling patriots to boost their Taiwan anti-independence fight. But there's also a lot going on in the South China Sea, too.
Yeah, particularly this week, and news out of the NPC perhaps pushed this to the back seat, but certainly it's skirmish near the Philippines, and certainly on the Philippine side, when you look at the news flow and the news cycle, they're certainly dominated by those specific events. I believe even the Philippine President Bongbong Marcos did need to come out and address that issue. I think it was yesterday. All that being said, do expect these things to feature, perhaps not in a microwave, but more in a macro way when the Chinese foreign minister speaks. As Yvonne is pointing out, that's one of the key things to watch this hour as well. On top of that, of course, China's top officials, in case you missed it yesterday, offering their reassurance, defending that growth plan in markets. In fact, reason why the 10-year yield is at 2.25% as we speak, and the governor, of course, at the PBOC hinting at further R cuts ahead. This on top, of course, the rate differential when it comes to the Fed.
Yeah, it's interesting, right? Because you hear no surprises from Jay Powell there, really backing rate cuts at some point this year, but that certainly helped the market in some way as well. That there was no surprise overall. Also, we're focusing on this scoop from Bloomberg as well. The U.S. said to be facing resistance on tighter China chip curbs, and they're trying to get some more of their allies on board for this. But there has been some pushback, too, on that, too.
From those allies as well. Yeah, I think that's the new news there. The U.S. is pushing more Now, we haven't really gotten reciprocity as far as that ask is concerned there. MSCI APAC Tech Index is up 1%. JD.com is up. In fact, a glance underneath the hood here. MSCI China, the big movers as we speak right now. On your Bloomberg terminal, we're looking at about 404 stock, give or take, up right now, 13% higher. Near session highs on onshore stocks. You might be able to see this. In case you don't, there's some big moves down as far as the Wuxi related stocks are concerned on and offshore. Wuxi Biologics, Wuxi AppTech on your screens. That's on the back of this bill in the U.S. pushing forward that would effectively prevent some of these names from getting federal contracts. And of course, the Asia dashboard looking like this. Asia's better by 0.5%. We're softer on the dollar and even softer than from a few minutes ago because of the strength coming through in the Japanese yen. Dollar yen now trading below 149 for the first time in about a month.
Yeah, you're getting more of these government officials signaling, according to our sources, that we are on the right path of hitting that inflation target. In fact, we're seeing much more progress when it comes to wages over these price gains as well. So does that set up for March to be live? The market is certainly very much in discussion about that, or at least April, at least, right? But we haven't seen moves like that in the yen from some time. Let's bring back to our top story when it comes to China. Obviously, this big press briefing that happened yesterday and really what we got out of it, and bring in Xing, Morgan Stanley chief China economist. I'm just wondering, your first report coming out from the work report was that the fiscal side insufficient. Did you hear more from this presser that changed that mind in any way?
No. The press conference yesterday provided the details about the package. First, the package size is still quite modest. There's not much expansion in either the official budget deficit or the augmented deficit, which includes everything, including local government financing vehicles. Number two, the package is largely supply-centric, focusing on upgrading of manufacturing capex, supply chain self-sufficiency, instead of stimulating domestic demand. So in our view, this means the deflation pressure in China will likely be persistent.
Yeah. What's the overall reception been from your clients?
I mean, investors are focusing a lot on what is China's plan to reflate the economy. And as of now, looks like the policy framework in China has been, they want to shift away from that credit-driven housing and the local infrastructure growth model, shifting to something more like high-quality growth. But how to interpret the high-quality growth? Policymakers seem to be focusing on manufacturing upgrading, green capex. But we do think deflation could be a self-fulfilling threat to the economy because we are seeing evidence is entering the second stage. After corporates start to cut back their lending, they slow down their hiring. And there is a deterioration in job and salary expectation. So that's not good. It could be a downward spiral, right? So we think the need of the hour is to reflate the economy with a much bigger consumption-centric stimulus. But so far, the MPC confirmed a modest package focusing on the supply side. So I think it will take time for China to reflate.
What do you think that boost from consumption is going to be for GDP growth this year then? Is it going to be stronger, or do you think it's going to be weaker than last year?
We have a below consensus nominal GDP forecast.
4.3, was it?
Yes, exactly. And after seeing the MPC package, I would say we may see further downside risk to that nominal GDP, because nominal GDP is the real GDP growth plus inflation. If the package is modest and the supply-centric, we may see China's GDP deflate, that the inflation metric continue to stay in very weak level, and that means the nominal growth could be subpar. And if you are a corporate saying quite subpar nominal growth, your revenue, your margin will face pressure. And of course, you want to slow down your pace of hiring. I don't think that's good for wage growth. So back to the question, consumption will be driven by income. And if wage growth are coming down, consumption growth will also face a lot of pressure. You may see consumers are downtrade on certain consumer categories because of the job expectations is coming down.
Yeah, in fact, we were talking with David Lee Dao-Quay on Monday. I want to get your reaction to what he said, because he has a proposal that he set forward to the government on how to boost consumption. Let's play it out, guys, if we can.
Proposing a policy to directly subsidize consumption. So, for example, in the coming May, we have a May break for 7 days or 10 days, long holiday for the nationwide. I propose that the central government roll out 1 trillion RMB to co-pay consumers' consumption.
It's not like consumers don't have money. It's just that it's in the bank, right? So that's half the problem. So what's the short-term fix, and what's the longer-term solution?
I mean, what David mentioned in the video, this near-term stimulus with subsidy, with some cash for clunkers trade-in program, they could help. But the medium to long-term solution would be, as you said, a lot of money was sitting in the bank, because consumers have this very high precautionary saving because of the concerns on social benefits, social welfare. Yeah. Exactly. So our proposal was, if they can spend, say, $1 trillion over the next 2 years' time as the provision to social welfare system to cover these more than 200 million migrant workers and their partners with access to schools, hospitals, and public housing. That could unleash this precautionary saving and boost the consumption much more meaningfully over the medium to longer run. So that could help China to decisively reflate from deflation.
Goldman had an interesting report this morning talking about the silver linings of this property crisis, that if consumers are not buying homes, maybe that excess cash that they're holding could be used for consumption. To what extent do you think that's a true narrative that could happen?
I mean, but if you look at the housing downturn, number one, it's going to have negative spillover to jobs, right? The housing-related sector is about 20% of GDP. So a lot of sectors will be affected by that crackdown. Number two, you also see wealth effect, like housing price coming down. How could that be positive for consumer sentiment? So I do think before talking about, okay, Chinese household will allocate more money to some other categories rather than housing, they need to have a stable job and income expectation first before they spend again. And all these consumer goods trade-in program subsidy, they could help in near term. But that social welfare spending, that fiscal transfer to the social welfare system will be the key. We see a little bit from the NPC. They set a budget of 40 billion RMB to cover these migrant workers' benefits. But that's not enough. If you look at the package on the supply side, they are allocating more than 400 billion RMB to provide incentives to corporates for capex upgrading. So that means so far the package is still largely supply-centric, focusing on manufacturing instead of consumer demand.
And do you think that policy support and the resources, is that getting funneled more towards the state-owned enterprises to push those goals, or is the private sector getting some of that goodness?
I mean, just from the budget itself, you can't see any preference between SOE or private firms, because the tax cut and the subsidy for manufacturing upgrading is for every firm. Doesn't matter if it's private or SOE. However, it's still largely about supply side. It's about creating more capacity instead of stimulating demand.
There we go. Okay, Robin Xing will be staying with us here, Morgan Stanley chief China economist. Lots more to talk about and unpack in the story. We'll now leave you with live pictures, this press briefing that's taken place at the capital, the Chinese Foreign Minister Wang Yi.
International relations. What do you think is the most effective way to tap the potential of Russia-China cooperation?
Under the strategic guidance of President Xi Jinping and President Vladimir Putin, the China-Russia Comprehensive Strategic Partnership of Coordination for the New Era has been moving forward on a high level. Political mutual trust is deepening, cooperation remains mutually beneficial and complementary to each other. The two peoples are enthusiastic about mutual exchanges. Last year, bilateral trade reached the record $240 billion, hitting the target of $200 billion ahead of schedule. Russian natural gas is fueling numerous Chinese households, and Chinese-made automobiles are running on Russian roads. All this shows the strong resilience and broad prospects of China-Russia mutually beneficial cooperation. Maintaining and growing the China-Russia relationship is a strategic choice by the two sides based on the fundamental interests of the two peoples. It is also what we must do to keep pace with the trend of the world. As key major countries of the world and permanent members of the UN Security Council, China and Russia have forged a new paradigm of major country relations that differs entirely from the obsolete Cold War approach. On the basis of non-alliance, non-confrontation, and not targeting any third party, China and Russia strive for lasting good neighborliness and friendship and seek to deepen their comprehensive strategic coordination. In today's world, hegemonism finds no support and division leads nowhere. Major countries should not seek confrontation and the Cold War should not be allowed to come back. The China-Russia relationship moves ahead along the trend of the times toward multipolarity and greater democracy in international relations, and is thus very important for maintaining global strategic stability, enabling positive interactions among major countries, and promoting cooperation among emerging major countries. This year marks the 75th anniversary of China-Russia diplomatic relations. The two sides will also jointly launch the China-Russia Years of Culture. The relationship faces new opportunities. China is ready to work with Russia to foster new driving forces for cooperation and steadily enhance the foundation of friendship between the two peoples. With Russia chairing the BRICS mechanism this year and China taking over the chairship of the Shanghai Cooperation Organization in the second half of this year, the two sides will strengthen international and multilateral coordination, practice true multilateralism, uphold the UN-centered international system, and safeguard regional and global security and stability. Thank you.
Welcome back. You're watching Bloomberg, the China Show. We'll take you straight back here to Beijing. That is the Foreign Minister, Wang Yi. Press briefing has been up and running for about 15 minutes or so. And so far, they've discussed a couple of things. China-Russia relations so far. We'll bring you all the latest from that once we do get some lines coming through out of the Foreign Minister. In the meantime, and perhaps we can talk a little bit more about foreign policy implications of industrial policy in China. Joining us still with us here on set is Morgan Stanley's chief China economist, Xing. It's increasingly becoming Wang Yi's job to almost justify industrial policy because it's starting to really get felt. EVs is a good example, right?
New productive forces.
New productive forces. And it seems like we're just at the very beginning of this chapter 2 or chapter 3 of this China exporting its goods to the world. Different kind of goods, of course.
That's right. I think it's also becoming part of the economist's job on interpreting this industrial policy because it's going to have ripple effect to certain areas and sectors in the world, not just domestically on China. For example, we talked about the package set by the NPC is largely supply-centric, providing incentives for domestic manufacturing capacity. What does that mean? That means that China will probably continue to double down on all these green capex, green product upgrading. But with a relatively weak domestic demand facing deflation pressure, these firms will try to export more and more. And what you just mentioned about chips, biotech, geopolitics, this means China's strategy right now in this stage is probably facing some interesting, it's like double-edged sword. Yes, China would have some first-mover advantage in EV, in all these sectors. But if you keep focusing on capacity in these sectors rather than domestic demand, there could be geopolitical pushback from other counterparties. You have seen it from U.S., probably also from Europe. So that's why our view has been if China wants to reflate decisively, it has to focus on domestic demand, not just creating manufacturing capacity.
Okay, Robin, just hold the thought as well. Our colleague, Colin Murphy, is asking a question to the Chinese foreign minister. Let's listen in.
Thank you. 彭博社，自去年中美元首旧金山会晤后，中美就共同处理分歧、推进互利合作达成了共识，但美方仍持续对华增加贸易和科技限制。 中方认为，未来1至2年间，这一趋势是否会有所转变？中方将如何应对？
The China-US relationship is critical to the well-being of the two peoples and to the future of humanity and the world. No matter how the international landscape evolves, China always keeps its US policy stable and consistent, and always handles the relationship with a sense of responsibility for history, for the people, and for the world. Our position is the 3 principles proposed by President Xi Jinping: mutual respect, peaceful coexistence, and win-win cooperation. They are a statement of the experiences and lessons of the 50-plus years of China-US relations, and represent the right way for interactions between major countries. They should be observed and acted upon by both sides. Specifically, mutual respect is the precondition, because interaction sustains only when differences in social and political systems are respected and acknowledged. Peaceful coexistence is the baseline, because conflict and confrontation between two major countries like China and the US have unimaginable consequences. Win-win cooperation is the goal, because when working together, China and the US can do great things conducive to the two countries and the world. At the historic meeting in San Francisco last November, the two presidents reached common understandings and charted the course for stabilizing the China-US relationship and bringing it back on the track of sound development. President Xi Jinping elaborated on China's fundamental approach and principled position on developing relations with the United States. President Biden reiterated that the U.S. does not seek a new Cold War, does not seek to change China's system, does not seek to revitalize its alliance against China, and does not support Taiwan independence. He also stated that the U.S. is glad to see prosperity in China and does not seek to contain or suppress China's development or to decouple with China. There has been some improvements in China-US relations since the summit in San Francisco. This meets the interests and wishes of the people of both countries and the world. But it has to be pointed out that U.S. misperception toward China continues, and U.S. promises are not truly fulfilled. The U.S. has been devising various tactics to suppress China and kept lengthening its unilateral sanctions list, reaching bewildering levels of unfathomable absurdity. If the U.S. says one thing and does another, where is its credibility as a major country? If it gets jittery whenever it hears the word China, where is its confidence as a major country? If it only wants itself to prosper, but denies other countries' legitimate development, where is international fairness? If it persistently monopolizes the high end of the value chain and keeps China at the low end, where is fairness in competition? The challenge for the U.S. comes from itself, not from China. If the U.S. is obsessed with suppressing China, it will eventually harm itself. We urge the U.S. to be clear-eyed about the trend of the times, view China's development objectively and rationally, engage in exchanges with China proactively and pragmatically, and to act to fulfill its commitments. We hope that it will work with China to bring the relationship back on the track of stable, sound, and sustainable development. This year marks the 45th anniversary of China-US diplomatic relations. President Xi Jinping pointed out that the hope of the China-US relationship lies in the people. Its foundation is in grassroots connections, its future depends on the youth, and its vitality comes from subnational exchanges. China is always ready to strengthen dialogue and exchanges with the U.S. and promote friendly exchanges in various sectors, so as to build more bridges for mutual understanding and remove unnecessary misunderstanding and biases. We believe that the two sides are fully able to find a right path for the two different major countries to get along with each other. Thank you.
谢谢，请大家继续提问。请北区第3排第4位这位女士。
Next question, please.
外长您好，我是新华社记者。国际上很多领导人都认为，当今国际秩序未能反映或适应国际现实力量变化。中方提出了倡导平等有序的世界多极化和普惠包容的经济全球化2大主张，受到国际社会关注和支持。
All right, that was live pictures coming through from Beijing, from Wang Yi, answering questions from our colleague Colin Murphy about how China will respond to tightening U.S. restrictions on Beijing's access to high-tech goods. Wang did say China-U.S. will continue mutual respect, but the U.S. has not promised or has not fulfilled the promises to China. Robin Xing, let's bring you back into this discussion here. It seems like the more we see tariffs or chip curbs and the like, that this is only going to get China to develop more of its homegrown technology. What do you still see are some of those hurdles that's needed for China to upgrade its own industries?
I mean, in near term, deflation is definitely not good for domestic innovation because corporates may have less incentives for hiring and investment if the nominal GDP growth and the corporate revenue growth are slowing down, right? So that's why I think in the past decades, whenever China faced domestic slowdown or deflation, they can try to invest in capex, in manufacturing and infrastructure, and they can always decisively reflate because there is a global market for them to absorb all this capacity. Right. However, now with all these geopolitics and the restrictions you just mentioned, I think this time is more challenging. So it's right to focus a bit more on domestic demand and use that social welfare provisions with a much more meaningful fiscal transfer to reflate the economy. I think this is different from 2001 when China just joined the WTO or 2008 to 2010 when China is upgrading its manufacturing sector. This time, geopolitics is different. That's why focusing on domestic demand, consumers, is even more important.
Can they do both at the same time?
I mean, yes, in many of these budget allocations, we have saying they are trying to balance between the supply chain self-sufficiency and also consumer incentives. Right. But so far, at the consumer front, the size is still too modest. Like they mentioned, the 5 trillion RMB potential upgrading in corporate capex, but only 1 trillion potential size on these cash for clunkers, like in cars and the home appliance market. So you can basically see that it's still a bit imbalanced. A lot of focus on the supply side, less so on the demand side.
You brought up another good point that, right after China entered the WTO, right? So I'm trying to get to this current period feels like that period. The only difference is the types of capacity they're trying to put in to manufacturing, right? And at that point, they exported themselves into growth. And I'm wondering this time around, it's just EVs. It's just a different product that they're exporting to the world. You mentioned there might be pushback because of geopolitics. We're getting news on tariffs, for example, potential tariffs out of Europe. Are we underestimating the fact that this might actually lead to a ballooning of its trade surplus again, the way we saw back in the early 2000s?
Well, earlier last year, we have done a lot of research on the global decarbonization initiative and what does that mean for China's EV market share globally, right? Because China is very cost efficient on the green supply chain. So we basically had 3 scenarios, like the blue sky. Basically, every other country is just focusing on efficiency. And of course, that means you just use this very affordable, cheap product as much as possible. And China is definitely dominating the supply chain in green product. We also have 2 alternative scenarios with a little bit trade frictions or much more forceful trade barriers. Like a lot of countries, particularly the DM, they want to put a restriction on the Chinese supply chain. They want to build their own. That was more than a year ago. And fast forward to today, as you can imagine, looks like the alternative scenarios of trade frictions is already emerging faster than we thought. So I do think today's world is different from the 2001 since China joined the WTO. So instead of just focusing on the supply side, China does need to focus more on domestic consumption demand.
And brings me to November 2024 with this U.S. election. It looks like it is going to be Donald Trump and Joe Biden in a rematch. What do you think that's going to mean for markets, for the economy? Are you starting to map out what the winners and losers are going to be?
I mean, what the U.S. presidential candidates proposed so far, like the potential tariff on China and even other trading partners, I think what we learned from 2016 was the tariff could have direct impact on corporate exports, but the more important impact will be on multinational firms' sentiment and confidence. That confidence effect could hurt investment. So I do think it will make all these global supply chain and investment more challenging with potential tariffs.
Yeah. You've underscored the point they need to do more to boost domestic consumption. It doesn't mean if we didn't hear it this week, we're not going to hear it this year. Do you expect more support for consumers this year?
I mean, it's still possible because the events or platforms to change economic policy is not just this MPC. China would have mid-year review of economic policy with the Polity Bureau meetings. So I do think if first quarter and the first half economic growth missed their target, which is possible, they could do more incremental fiscal easing to support the consumers after these mid-year Polity Bureau meetings.
Robin, always great to have you. Thanks so much for sticking around. Robin Xing there, our Chief China Economist at Morgan Stanley, joining us here in our Hong Kong studios. And we're continuing to check what goes on beyond just China, right? So it's not just what we're seeing with the tech space, healthcare stocks, but JGB's Japan, the yen, is becoming more of our top story here today, even on the China show.
Interestingly enough, since you brought it up, so a BOJ board member, in fact, this is a speech, I believe, that just took place. The timeline says Thursday, so give or take in the last few hours or so. Junko Nakagawa has indicated the timing for a rate hike is coming closer by noting progress towards achieving the price target. So I'm going to fancy a guess. All the commentary along this oriented towards this planting the seeds of normalization. This might be a deliberate process, of course. Markets are somewhat listening, right? So equity markets are down, but within this equity market, bank stocks are up 8%. Yields have been pushing high. The yen is strengthening as well. So maybe to give us something to think about, of course, ahead of the BOJ meetings.
Yeah. Certainly there seems to be a growing chorus of this here right now. And your Asia dashboard, if we look at it broader, and this is how things are looking like. So the Nikkei is still down about 1% here, maybe on the back of that stronger yen. A50 futures, APAC stocks here are slightly up about a fifth of 1%. So we're still seeing a decent rally, although we have seen some downside when it comes to Hong Kong. In particular, U.S. futures, though, extending those declines are down about a third of 1%. Let's bring in our MLI strategist, Mark Cranfield, to walk us through some of the moves. Maybe I'll start on the yen and what we're seeing here, even when it comes to Japan overall. I mean, speculation seems to be brewing once again, Mark, that the BOJ is ready to tighten policy maybe as early as this month. How should we be reading all this? What's the price action looking like to you?
Yeah, I mean, the March meeting is obviously very live as far as traders are concerned. They seem to think there's a decent chance. So I think one of the key things we've heard this week is that you've had the biggest bank in Japan talking about their trading positions are geared towards the Bank of Japan actually exiting negative rates at the March meeting in 2 weeks' time. So that's a very significant signal for other people in the market. But probably the biggest change that we've seen in the recent weeks is the way in which we get continuous flow of media stories. You were just talking about another Bank of Japan speaker there today. We've got another. Bloomberg is reporting a story that even people within the Japanese government are no longer resistant to the Bank of Japan changing policy. The tone has changed dramatically in recent weeks. So what we got used to last year, every time we heard something that suggested the BOJ was getting close to an exit, there would suddenly be a media story pushing back against it. There will be something to say, oh no, they're not really ready. There are still people within the committee who don't agree. Everything has changed. The narrative is completely different. All the little stories we see incrementally are pointing towards the fact that the BOJ is getting very close to a consensus. It's just a question of when they exit negative rates. It's no longer that they can't do it or they're not ready. It's just the precise timing, whether it's going to be the March meeting, the April, or as some people think, July. The consensus in the market seems to be coming around to April, particularly because that's just after the Japanese financial year end. Probably it makes a little bit more sense. That isn't going to stop the speculation getting really hot for the March meeting. There's still enough time for traders to make money. You can see dollar yen moving quite a bit this morning. JGB yields are also going higher as well. So next week is going to get fast and furious. Probably every single day there'll be something coming out with people pointing towards the March. Whether we get it or not, there's a chance for traders to make lots of money because markets only need to move in advance of the meeting. They don't even need to wait for the actual decision itself. This isn't going to go away, and even if they pass in March, then it will just get even more speculative for an April decision.
Mark, what's stopping them from moving in March? And the reason I bring that up is you brought up a very good point. The messaging seems to be consistent across the board, media, government, BOJ, and it seems, to your point, things have changed, right? They're not simply planting an idea and seeing how the market reacts. Do you think the BOJ is locked and loaded, that they might actually move?
You can never rule it out. They've surprised us many times over the past few years. I suggest the biggest hurdle is the fact of the Japanese financial year end comes at March 31st. And it could disrupt. If they go on the 19th of March, it still gives the markets plenty of time to swing around and possibly upset some of the financial planning for Japanese companies for the year end. Maybe the Bank of Japan would like to avoid that. That would just maybe cause more trouble than it's worth. So why not go a few weeks later when they would cause less damage to balance sheets? Doesn't mean to say they wouldn't do it, but I suspect that's the biggest reason that would hold them back.
The next one to watch really is going to be the ECB market. I'm just wondering, in terms of how closely they're watching this Fed discussion, what Jay Powell said in their testimony, but how soon do you think the ECB could actually start talking about rate cuts?
Well, Christine Lagarde has been saying for a while she doesn't really see it in the first half of the year, and the Fed has made that easier for her by Jerome Powell pushing slightly back on that. It certainly makes the ECB's job a little bit better in terms of wanting to hold on. They're certainly not going to move today. But of course the data is beginning to go against them. Inflation is falling, maybe not as quickly as they like. But Germany, the biggest economy in Europe, went into contraction at the end of last year. Doesn't look very good at the moment. So the growth numbers are pretty poor. Inflation is heading the right way. Increasingly, the ECB will come under pressure to move before the Federal Reserve. They probably would like to wait until afterwards, but it's not going to be so easy for them. So they will push back today, but I suspect that Christine Lagarde will start opening the door. She realizes that she can't resist for too much longer, and probably in her press conference today, she'll probably sound a bit more dovish than the market is expecting, which could push the euro down a bit. That's probably where the market will take it out. They'll probably look at the euro against the US dollar and say, well, the Fed's holding on, but the ECB is getting a little bit closer to lowering its rates.
Mark, how are you looking at this, just to turn our attention to China, this CGB rally, and we're close to taking out 2002 lows in a 10-year yield. And I appreciate as well that there's a big group of traders out there that don't actually have any sort of skin in the game as far as CGBs are concerned. So how are you thinking about this?
It's very reminiscent of what we saw in Japan. It's like the only game in town. The one thing that you can probably be fairly certain of in the Chinese world is that yields need to come down, and they probably need to come down quite a bit from here. The economy needs it. The PBOC has said several times that they still see more easing ahead. They repeated it again this week. The rate cuts will probably come relatively slowly, but if you're someone invested in fixed income, the highest grade you can go for is the Chinese government bonds, and you can see that the central bank has got your back. So really, it might be a slow trade. It may take a long time to play out, but it's very difficult to persuade investors to go against Chinese government bonds when the central bank is pulling in that direction and the economy is underperforming. It's almost like, well, you're giving us a gift here. We might as well just keep pushing on the same direction.
Mark, thank you. Mark Cranfield in Singapore for us. Ending the conversation there on this, certainly it's what's really been a one-way trade that's down on Chinese CGBs. Plenty more ahead. This is Bloomberg.
Let's take you back to those live pictures in Beijing, where the foreign minister Wang Yi is continuing with this presser, which has been going on for about close to an hour now. Let's get to our China economy and government reporter, Lucille Liu, who's been tracking all that goes on in this briefing. And, obviously he's come up with some harsh lines when it came to overall relations with the U.S. and the like. Taiwan certainly is something we'll talk a little bit more about. But what stood out to you?
Yeah, I mean, it was interesting. The second question of the presser was on China-Russia. And of course, China reiterating that line that they're, going to grow relations with Russia, that they have this new paradigm in their relationship that's, not based in the sort of Cold War era. So, yeah, really reaffirming those ties with Russia, which has, of course, strained its relationship with, the rest, with Europe and European countries. And of course, also responding to a question from Bloomberg on U.S.-China relations. Although I hear the tone of his voice has gotten a bit softer or a bit warmer coming off of sort of San Francisco and that stabilization of ties. The words, though, as harsh as always. Just looking at some of them, talking about the sanctions list, he's saying that's reached a bewildering level of unfathomable absurdity. And of course, saying that the U.S. is trying to monopolize the high end of the value chain and keep China on the low end. So hitting out pretty hard at U.S. economic policy, especially as we know the U.S. is trying to convince allies, and there's more coming in terms of restrictions on exports, especially in tech, to China.
He also talked about, and I think this goes into what the last point you just made here, Lucille, this misperception that he, and of course I would imagine many people in Beijing still think that people still outside of China still hold as it pertains to China. Talk a little bit more about that and his pushback against that.
Yeah, I mean, I think, China, often we call this sort of, China's greatest hits, sort of presser, where they say a lot of what they've consistently said over the year. And of course, misconception is one of the big ones. But I think it also comes off of this sort of not recognizing or not wanting to recognize anything that China has done wrong. So really the result is, of course, because of misconception. So, so I mean, I think especially because so much of this or so much of these restrictions are based on national security concerns, I think China's line for this typically is that, the U.S. is overstretching and it's sort of paranoid about what constitutes its national security, and that, what most of China is doing is not a risk. So that's some of what that misconception that he's pointing to is about.
Yeah, there we go. And that really all comes together, I think, right now, tangibly with the battle for semiconductor supremacy and independence on the supply chains. Lucille, thank you so much, Lucille Liu, in Beijing for us. In fact, just earlier on that very point, Wang was asked about the tightening of these U.S. restrictions on China's access to high-tech chips. Have a look.
But it has to be pointed out that U.S. misperception toward China continues, and U.S. promises are not truly fulfilled. The U.S. has been devising various tactics to suppress China and kept lengthening its unilateral sanctions list.
Let's bring in Peter Elstrom, our senior executive editor for Asia Tech, to talk us through this Bloomberg scoop on those chip restrictions. Peter, I guess let's start with this. Who did the U.S. tap on the shoulder and ask to tighten their restrictions on China this time?
So what sources have told us is that the U.S. is going to four key allies at least, the Netherlands, Germany, Japan, and South Korea, and asking them to tighten up these restrictions around China. As you know, the U.S. has been imposing restrictions on the shipments of semiconductors and chip-making equipment to China for a couple of years now. They've gone 2 rounds of doing U.S. controls in particular, but they need the allies on board to be able to actually make this blockade around China successful. Much of this valuable equipment comes out of other countries, particularly the Netherlands and Japan. It took the U.S. a while to get those 2 allies on board in the last round of discussions on this front that did mostly happen last last year. Now we understand that they're going a little bit broader, going to Germany and South Korea in particular, since those two countries also play a pretty particular role. So Jake Sullivan has articulated the strategy as a small yard and a high fence. The yard is getting a little bit bigger here, and I think that's what you're hearing is pushback from China and from some of the companies involved. Some of these countries are not on board with going along with this extra tightening of the restrictions.
And why is that? Can you tell us a bit more? I mean, it sounds like from the scoop that, you know, Tokyo, The Hague in particular, are countries that are responding quite coolly to this.
That's right. Japanese companies and Dutch companies play a pretty key role in chip-making equipment in particular. ASML in the Netherlands is the leading provider of the highest-end chip-making equipment. Tokyo has some of the similar companies too. And so they cut off shipments of the highest-end machines last year. And the point that they've been making as pushback to the U.S. is that we need to spend some time and see whether the restrictions we imposed last year are actually going to work before we talk about new restrictions. They're also, of course, worried about the business that they're going to get. These companies have made a lot of money by selling equipment into China over the years. ASML in particular has been quite outspoken that it would like to continue to sell a lot of that equipment at this point. And the critics have argued that this strategy could backfire. You could encourage China and Chinese companies to accelerate their own development of the chip industry, of some of these chip-making equipment companies too, and therefore there's going to be domestic supply even if they try to cut it off from outside the country.
All right, Peter, thank you so much. Our executive editor for Asia Technology, Peter Elstrom there. We'll take you back to those live pictures coming through in Beijing with the Foreign Minister Wang Yi's presser. Let's listen in.
The 70th anniversary of the 5 Principles of Peaceful Coexistence. Although born in Asia, the 5 principles transcend differences in social system and ideology. They have become basic norms governing international relations and fundamental principles of international law, contributing the wisdom of the East to properly handling state-to-state relations. 70 years later, the 5 principles of peaceful coexistence are not outdated. They're even more relevant and vibrant than ever. China stands ready to work with our neighbors to carry forward the 5 principles of peaceful coexistence toward building a community with a shared future for Asia and for mankind, so that Asia can continue to contribute to world peace and provide impetus to global growth. Thank you.
The recent volatility in the market once again exposed some deep-seated problems which deserve serious reflection. We must treat investors with sincerity and provide them with better services. We need to strengthen investor protection in terms of laws, institutions, regulatory enforcement, and judicial practices so as to give them greater trust and confidence in the market.
There you go. That was the CSRC chairman, in case you didn't know here. And in fact, today's papers across China here also have articles relating to some of these regulations as it pertains to the securities markets. In fact, in today's version of the China Brief here, the China Securities Journal reporting that the chairman of the Shenzhen Stock Exchange wants accountability increase for major illegal acts in the market. So really consistent with what we just heard there from the CSRC chair, Cheyenne. Also wants laws related to financial fraud to be tightened. Meanwhile, you have senior players in the financial sector have told, this is in the Securities Times, that they are optimistic about the development of China's capital markets, and that certainly after the economic chiefs did hold that press briefing, joint one, on Wednesday, Yvonne, on that very growth outlook.
Yeah, it's interesting when it comes to that national team, right? Jeffrey said an interesting note that they might see that fade a little bit, that state support, if markets could actually hold on to that recent rebound as well. In terms of what's trending on Weibo, one of the key stories that we're talking for you today is a CPPCC member calling for a full gaming ban for children 18 years and younger. What is his reason? Well, the kids these days are just obsessed with games, and China moved, of course, to tighten those restrictions on its gaming industry late last year, leading to that $80 billion rout. Well, it seems like this proposal, you could see just some of the comments are coming through from netizens. They're not taking it too well. And just keep in mind, some of these are just laced with sarcasm, right? One saying, look, what's next, right? If you're going to ban video games and games, you might as well just ban adults that can make more babies to boost the fertility rate. Another one says, you know what? If you want to stop kids from playing games, maybe you should just cancel those college entrance exams. I wasn't too sure about that one, right? If you cancel the Gaokao, does that mean you can play more games, or is it just like you're just less stressed, therefore you don't need to play the video games? But certainly, yes, there's just lots of jokes on social media right now just about this very topic.
I guess there's less reason for the need to unwind playing games. One of the other things that actually came through as well is, on the comments front here, is I called for a full ban, this is obviously sarcasm as well, a full ban on cards and mahjong. So if our games are not okay, your games are not okay as well. And classic, really, this generational gap. And I remember really growing up, and certainly there were calls to ban TVs back then because kids back then spent too much time on TVs. And now, no one actually watches TV. So in the event that one or two of you are tuning in to Bloomberg TV, the China show, thank you for joining us, a look at markets right now.
You mean they're watching it from their cell phones?
They are.
Not a TV.
Or the elevators.
Yes.
We're big in elevators.
We're taking a look when it comes to other broad themes, right? And it's still Japan, Dave.
Yeah, government officials are Bloomberg Scoop supporting a rate hike. And then shortly after that, a BOJ member also seeing the possibility and the timing of a rate hike coming closer. Dollar yen coming off lows of the day, but certainly trading below 149 for the first time in about a month's time. Risk reversals are pointing to certainly bullish signs, or signs that a rally perhaps is in the offing as far as the Japanese currency is concerned. Here, very, very quickly, Chinese healthcare stocks, poleaxed there, as you can see. This U.S. bill, this Senate bill advancing through that, which would prevent many of these companies from getting those contracts.
Yeah, so certainly
federal contracts.
Yes, and that is why we're seeing these healthcare, just double-digit losses. And they certainly got hit the first time when they were exploring this U.S. biotech bill. It looks like it's now advancing when it comes to Congress. Your China dashboard is looking like this here right now. Obviously, JD.com is one that we're watching out for, but it's not really helping Asia's tech stocks in particular. We're slightly elevated there, but the biotech space is certainly that's what's dragging it. CGB is continuing this rally once again. Look at the 30-year yield. We're down some 2 basis points at 242. We're very close to that 10-year yield, hitting that record low as well on the back of those PBOC comments as well. And it looks like we're seeing both onshore and offshore markets at least back in positive territory, with the CSI 300 really outperforming Hong Kong here today. We're up about 0.4%. That's it from us here from the China show. We got Bloomberg Markets. Asia is next. Stay with us. This is Bloomberg.